Hey everyone, and welcome back to the Financial Flux. We've all seen the headlines, right? Fed to cut rates, rate cuts imminent, relief on the way. It seems like every conversation in real estate, from commercial to residential, is centered on one thing, waiting for the Fed to ride in and save the day. But what if I told you that a Fed rate cut, especially a small one, might not be the magic bullet we're all hoping for? In fact, what if I told you that anticipating a rate cut might actually be the wrong way to think about long-term debt rates? This is the critical difference that a lot of people are missing. There are two major types of rates at play. On one hand, you have short-term rates. This is what the Federal Reserve controls with its Fed funds rate. This impacts things like floating rate debt and short-term credit lines. Yes, a lower Fed rate can certainly help in that regard. On the other hand, you have long-term rates, and these are a completely different beast. They're controlled by bond traders and the global market. Think about the 10-year Treasury yield, which is a major benchmark for things like mortgages and commercial real estate loans. So why are these two so different? Well, while the Fed's actions do matter, long-term rates are a reflection of what the market thinks about the economy as a whole. They're driven by fundamentals like economic growth, fiscal policy, and most importantly right now, inflation expectations. And here's where it gets complicated. We're already seeing renewed inflationary pressures, whether from geopolitical events, tariffs, or supply chain shifts. If the Fed cuts short-term rates, it could actually pour more fuel on that fire, making the market even more concerned about inflation. And when the market gets worried about inflation, what do long-term bond traders do? They demand a higher return to offset that risk, which drives long-term rates up, not down. Think back to last September. The Fed cut its key interest rate by a full 100 basis points. That's a huge move. And everyone was celebrating, assuming long-term rates would follow suit. But what actually happened? In the months that followed, the 10-year Treasury yield climbed 75 basis points in the exact opposite direction. Not very ideal. Yes, we all want to see lower rates. I'm in this business just like you are, and I get it. But we can't afford to be deluded. We can't just cross our fingers and hope that Jay Powell or a new Fed chair will magically fix our problems. The truth is, the forces that really move our industry, the ones that impact asset values, loan sizing, and cap rates, are tied to long-term bond yields. And those yields are influenced by a much larger, more complex set of factors than just a simple Fed decision. So instead of obsessing over the next Fed meeting, let's focus on what we can actually control, making sound decisions based on the current market reality, not a hopeful future. Thanks for watching. What are your thoughts? Are you focused on the Fed, or are you looking at the bigger picture? Let me know in the comments below. And don't forget to like and subscribe for more content like this.